What the heck is going on down here? I don't know.
The Dow Jones Industrial Average dropped more than 900 points.
Yeah.
Fear came back into the market in a very big way.
What if I told you the next big market crash isn't just possible, it's guaranteed. Every 7 to 10 years, the markets remind us of a hard truth. What goes up must come down. History has shown us that financial markets don't rise forever. Think about the dot-com bubble in 2000, the 2008 financial crisis, or the COVID crash. Every bull market eventually hits a wall. Markets always move in cycles. Boom, bust, recovery, repeat. It's as natural as the tides of an ocean. But every time a crash is on the horizon, people act shocked. Here's the truth. Recessions aren't weird outliers. They are part of how the economy grows. They wipe out overvaluations, curb speculation, and pave the way for long-term stability. So, the real question isn't if another market crash will happen, it's when. And even more importantly, will you be ready for it? In this video, I'll break down how market crashes happen. I will explain the tools I use to detect them and how to protect and even grow your wealth during the next downturn. Because while most people panic in a crash, the smart ones, they profit from it. Let's make sure you're one of them. The market is designed to crash. So why does the boom and bust happen? Markets don't just go up and down. They follow a pattern called the market cycle, which has 4 phases: expansion, peak, contraction, and recession. This isn't just some theory, it's been happening for centuries, roughly every 7 to 10 years. So here's how it works. First, there is the expansion, the good times. The economy is growing, unemployment is low, and prices for stocks, real estate, and so forth are climbing. Everyone's optimistic and investing. Then there's a peak. And this is where things start getting a little too good. Prices shoot up to unsustainable levels, fueled by speculation, and bubbles form. Now for a reality check. Contraction. This is where growth slows, inflation rises, and interest rates go up. Panic sets in, and people start selling out of fear. Then there's a recession, the bad times. This is where the market prices drop, unemployment rises, and fear takes over. However, this phase is also very important for the market to clean the slate and sets the stage for the next expansion. Our takeaway: booms always lead to busts. And while it might sound scary, it's not all bad, because crashes help shake out excess speculation and reset markets for healthy growth. Higher and lower interest rates. Market crashes don't just come out of nowhere. There are always warning signs if you know where to look. One big clue: GDP growth. When the economy slows down and contracts, it's often a red flag that trouble could be brewing. Then there's the bond market, which can be surprisingly accurate at predicting recessions. If the yield curve inverts, meaning short-term bonds pay higher interest than long-term ones, it's historically signaled every US recession in the past 50 years. And let's not forget about inflation. When prices rise too quickly, the Federal Reserve usually steps in by raising interest rates to cool things down. But that can sometimes lead to its own set of problems, like a downturn. Add in market speculation, institutional trading trends, and overvalued assets, and you've got a perfect recipe for a market crash. So it's not a matter of if, but when. So, what does the Federal Reserve have to do with market cycles? The Fed plays a big role in managing the flow of money in the economy. And one of its go-to tools is raising or lowering interest rates. Here's how it works. When the economy is running too hot, with too much money flying around and speculation is going wild, then the Fed steps in by raising interest rates, making borrowing more expensive. So investments slow down, businesses tighten their budgets, and market bubbles start to burst. And vice versa, lowering interest rates encourages businesses to invest in consumers to spend more, especially on big ticket items like homes and cars. Lower interest rates reduce the cost of loans, mortgages, and credit cards, boosting demand for goods and services. and the economy in general. However, if rates stay low for too long, it can lead to inflation, overvaluation, and essentially asset bubbles, as money becomes overly abundant. So, how do you spot an overvalued market before it all goes south? There are a couple of handy tools. First, let's take a look at the Buffett indicator. This tool compares the total stock market value to GDP. If the market's value is way higher than the economy's output, a correction might be around the corner. It's pretty straightforward. Here's how it works. Buffett indicator equals the total market capitalization of stocks divided by GDP. If the stock market is larger than the GDP, we'll get a result of over 100%. Meaning the stock market is overvalued relative to the size of the economy, which may indicate market correction or downturn could be more likely. If the market capitalization of stocks is lower than the GDP, we'll get a result lower than 100%, signaling an undervalued signal which would give us a buying opportunity to the market. If you've been following along, this shouldn't be new to you. I've mentioned our proprietary valuation tool before. It actually does something pretty similar to what we are talking about. This tool uses an AI learning model to process huge amounts of data and refine predictions, comparing them to the current valuation of gold, bonds, and US dollar, giving us spot on insights into whether any stock or asset is overvalued or undervalued at any given moment. Another great tool we have, and I have talked about this many times before, the decennial pattern. This theory suggests market crashes tend to follow a predictable cycle based on the last digit of the year. For example, years ending in 0 and 7. Big crashes like 2000, the dot-com bubble, 2007, the peak of the housing bubble, and 2020, the COVID crash. Years ending in 5 and 8, they are usually all about market rebounds. And they unfold pretty similarly every time. The year opens with a crash and closes with a new peak. I've mentioned all of this in my 2025 market prediction video. So far, my predictions have been spot on. I called the recent market crash weeks before it happened. How did I make this prediction? Well, I used tools such as the decennial pattern and the valuation tool, both of which are backed by over 100 years of market data. I believe that with the right set of tools and parameters, you can make accurate predictions about market trends, including potential crashes, just like I did. It's all about having the right tools and applying the right analytical approach. Now that you know the tools, it's time to talk about what really matters: protecting your portfolio before the storm hits. Most people panic and sell when the markets crash, but the smartest investors, they are ready for it. Here's how you can prepare. Focus on keeping your money safe. When the market is booming, it's tempting to chase those last-minute gains by taking on more risk. But that's a gamble that can backfire fast. Instead, think about preserving your capital. Build a wealth-building account that focuses on keeping your money safe rather than going after risky returns. The goal is to have cash on hand so you can make smart investments when the market dips. We learned this from Warren Buffett. When his cash allocations are through the roof, well, you already know what does this mean for the economy. This fits perfectly with what we learn from supply and demand as well. When the market is booming, it's in supply. That's when we sell and keep our cash reserve on hand, waiting for the market to cool off and thus find entries to buy at the next demand zone. But in this case, we're talking about monthly supply and demand zones. So, how do you take advantage of a market crash? When markets tumble, most investors panic. But those who understand how market cycles work know that crashes are the best times to build wealth. When it comes to market crashes, there are two main strategies. Long-term investors can use dollar cost averaging to consistently buy blue chip stocks or safe haven assets like gold or Bitcoin at lower prices. Then hold on to them for years. And swing traders can analyze supply and demand to pinpoint smart entries and achieve a more profitable risk-to-reward ratio. For those with more experience, there's also a way to make money when markets fall. shorting the entire crash. And to do that, you'll have to analyze both macroeconomics and supply and demand on a higher time frame. You will need to take another look at the fractals. Those who could forecast the beginning of a sideways action that's usually followed by a crash will find prime locations to short the market from the top. And we already explained all of that in our supply and demand lessons on the channel. In short, market crashes don't have to mean panic, they should mean they can be a gold mine for patient investors. Stocks that were too expensive suddenly become affordable. It's like a clearance sale for strong assets. As Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Market crashes must happen. They are a natural part of the market cycle. Instead of dreading them, the smartest investors prepare and take advantage of the opportunities they bring. To thrive in any market, it's all about the right mindset and strategy. Stay calm, avoid emotional decisions, don't over leverage, and learn to recognize economic cycles. That's how you stay ahead. Actually, there's an easier way to stay ahead, which is a sub to this channel. So, are you ready for the next crash? Drop your thoughts in the comments, and as always, I will see you in the next one.